Welcome to Richard Suttmeyer's 4 and 4. 4 blips on my radar screen presented in 4 minutes or less. Today I focus on the Federal Reserve's new term securities lending facility and its potential impact on yields in the mortgage market. My first blip congratulates the Federal Reserve for being creative, but many will consider the program a backdoor bailout. I just hope the program puts a stop to the rate cut madness. The new term securities lending facility essentially swaps illiquid mortgages for short-term U.S. Treasuries for 28 days. This should help ease the credit crunch on Wall Street. In terms of the 30-year bond, the bond conundrum will not end. The yield on the 30-year is trading between 4.10 and 5.60 over the past 5 years, and this range should continue. My second blip discusses the impact on market yields. At the discount window, the margin is 90% for private label mortgage-backed securities for which there are no market prices. The primary dealers still do not know the collateral margin requirements yet for this new facility. The idea is to re-liquefy the mortgage market on the theory that mortgage rates will decline in correlation with the Federal Reserve funds rate. This could be wishful thinking. U.S. Treasury yields rose significantly on Tuesday as the announcement of the program caused a reversal to the flight to quality. Yields rose by 28 basis points for the 2-year, 26 for the 5-year, 16 for the 10-year, and 8 for the 30-year bond. These higher Treasury yields more than offset the tighter spreads for Fannie Mae debt. Yields for 5-year and 10-year Fannie Mae debt tightened by just 13 basis points in the 5-year and just 8 basis points in the 10-year. Fannie Mae debenture spreads are still wider by 50 and 34 basis points year-to-date on those 5 and 10-year maturities, and wider by 101 basis points and 85 basis points respectively. My third blip profiles the risk-reward of handling a flood of mortgage refinancing. The sizes of conforming loans are now allowed to be above $417,000, but just for 1 year. With the spread between jumbo and conforming mortgages at 100 basis points and wider, there will be a flood of refinancings and new securitizations. Several Wall Street firms just fired many security specialists, mortgage-backed security specialists, and with capital constraints will have difficulty providing the secondary market liquidity for an increased supply of new mortgage-backed securities. In addition, investors will also be reluctant to buy new mortgage-backed securities as the structures created over the next 12 months will be tainted by loans that will not be able to be refinanced once the ceiling goes back to $417,000 in 2009. My fourth blip profiles the housing and regional banking indices, which tested January lows on Monday. The residential housing sector index, HGX, stayed above its year-to-date low at 117.41 on Monday, but closed below my quarterly pivot at 141.04. At Monday's low, HGX returned to levels not seen since May 2003, before the housing bubble began to inflate. The regional banking index, BKX, represents 24 regional banks, including Bank of America, Citigroup, JP Morgan, and Wachovia. The year-to-date low is 74.84 with the 5-week modified moving average at 84.55. Monday was close to a retest of the January 22nd lows, not seen since April 2003. So this took the regional bank index back to levels seen before most of the toxic problem mortgages were originated. Send your comments and questions to support at rightsideadvisors.com. That's today's 4 and 4. Enjoy your day.